Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we'll review 10 of the best monthly paying REITs for investors to buy in 2024 and beyond. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Real estate investment trusts, also known as REITs, are beloved by income investors. Since REITs have to pay out at least 90% of their taxable income in the form of dividends, they can be a good source of passive income with good dividend returns. Quarterly dividends are nice, but wouldn't it be great to have regular dividend income you can count on every month? One way is to take some spare cash and build a basket of monthly dividend-paying REITs. With REIT prices down so much this year and dividend yields so high, now is a great time to pick up some high monthly income payers. A good REIT basket, however, should have sector diversity, a respectable dividend yield, and a careful selection of the REITs and funds from operations, FFO, that will cover the dividend payments to prevent dividend cuts. You can build a basket with a lump sum of money divided evenly among all 5 REITs, or just buy an equal amount of shares of each. With that said, here's our list of the 10 best monthly paying REITs for investors to buy in 2024. Number 10. Dynex Capital Incorporated, ticker, DX. DX is an internally managed mortgage REIT that invests in both commercial and residential real estate mortgage-backed securities, or MBS. Investors should know that DX invests on a leveraged basis, meaning it uses borrowed money to buy MBS on margin. Leverage has the effect of enhancing performance on the upside but can also accelerate losses on the downside. DX owns both agency and non-agency commercial mortgage-backed securities, CMBS, and residential mortgage-backed securities, as well as interest-only CMBS. With interest rates rising over the past 2 years, DX and most other mortgage companies have struggled, but the rate hikes appear to be coming to an end and rates will eventually fall. When that happens, DX should benefit. Number 9. Chatham Lodging Trust, ticker, CLDT. About 40 high-end hotel brands, including Residence Inn, Hyatt Place, and Hilton Garden Inn, are managed by Chatham Lodging Trust. Chatham looks to take advantage of properties where demand currently outpaces supply, paying particularly close attention to those that might be undercapitalized. Chatham does more than just own hotels. It also takes an active management approach by rebranding, revitalizing, or redeveloping properties that add value for both the hotel and shareholders. Number 8, Agree Realty Corporation, ticker, ADC. Agree Realty pays a 3.61% annualized dividend and trades on the New York Stock Exchange with an average daily volume of 815,000 shares. The monthly dividend payment is 23 cents per share. The company is primarily focused on the ownership, acquisition, development, and management of retail properties net leased to industry-leading tenants. It focuses on owning properties leased to essential retailers such as grocery stores, home improvement, dollar stores, and drug stores, which are less susceptible to disruption from e-commerce or a recession. This strategy enables Agree Realty to generate steady rental income to support its dividend. Agree Realty switched from a quarterly to a monthly dividend payment schedule in January 2021. It has an excellent dividend track record overall. This REIT has increased its dividend at a 5% compound annual rate over the past decade. Agree has been in business since 1971 and has been publicly traded since its 1994 initial public offering. Credit Suisse Group AG analysts initiated coverage of the REIT in June with an outperform rating. Bank of America Corporation in June upgraded Agree from neutral to buy. Agree Realty has a strong balance sheet to help finance its continued expansion. That leads it to forecast acquiring another $1.1 billion to $1.3 billion of properties in 2024 to support continued dividend growth. Number 7. Broadmark Realty Capital Incorporated, ticker, BRMK. BRMK provides short-term lending to real estate investors and property developers in the form of first-position deeds of trust and mortgages. The funding provided by Broadmark is typically used to fund the purchase and/or development and renovation of both residential and commercial real estate assets. The average loan size provided by Broadmark is about $7 million. Broadmark has been around for about 12 years and has funded over 1,200 loans worth just less than $4 billion. The company has a current loan portfolio worth around $1.6 billion, with real estate assets securing 227 loans located in 20 states. Broadmark is on our list because of its consistently high monthly dividend, its strong underwriting, and the fact that alternative lending, like what the company offers, is likely to become more popular in the next year or so as traditional banks tighten their lending standards. Number 6. AGNC Investment Corporation, ticker, AGNC. Despite a slowing housing market, real estate stocks tend to do quite well during periods of inflation, and they're known as some of the best picks for monthly dividend investors. AGNC Investment Corporation is a REIT that invests in mortgages. REITs enjoy a number of tax benefits and have to pay out at least 90% of their taxable income to shareholders. AGNC has been paying out monthly dividends of 12 cents per share for a long time. Because AGNC invests primarily in large, federal guaranteed loans, backed by the likes of Fannie Mae and Freddie Mac, this stock is seen as a fairly low-risk option despite its 12% dividend yield. Based on the company's preliminary results for the third quarter, it had a total investment portfolio of $61.5 billion at the end of September 2023, of which only $1.7 billion was in assets that were not agency or credit risk transfer assets. Almost the entire portfolio is comprised of agency assets, which are protected by the federal government in the event of default. There's quite a bit of safety built into AGNC's supercharged yield. AGNC is on our list because it has a high monthly dividend, invests in low-risk assets, and gives investors some peace of mind in an economy that is becoming more unstable. Number 5. Realty Income Corporation, ticker, O. Realty Income is a retail REIT with over 11,400 worldwide commercial properties on long-term net leases. Its tenants are large well-known companies like Walgreens Company, Dollar Tree Incorporated, and FedEx Corporation. Its portfolio is huge, with over 11,700 properties. Realty Income has an investment-grade rated balance sheet, and its shares are generally afforded a premium to its peers, which leads to lower capital costs. When you put all of these factors together, Realty Income has the ability to keep doing deals even when market conditions are tough. And as it expands, it can continue to support higher dividends. A key differentiating factor is that it can also handle larger deals that smaller peers couldn't even consider, which gives it more avenues for growth over the long term. Realty Income is one of the most popular well-followed REITs. It's one of only 65 S&P 500 dividend aristocrats because it has increased its dividends 117 times for at least 25 consecutive years. Number 4. EPR Properties, ticker, EPR. EPR Properties is a diversified experiential REIT that owns and operates 358 movie theater chains, amusement parks, resorts, and other recreational venues. It secures these properties by signing triple net leases with the venue operators, meaning the tenants bear the responsibility for building insurance, maintenance, and real estate taxes. The 2020 pandemic forced EPR Properties to cut its quarterly dividend. EPR Properties stock fell from $54 to $35 in August as a result of its movie theater tenant Cineworld Group plc filing for Chapter 11 bankruptcy, but it has since increased by 11.5%. EPR Properties has demonstrated remarkable resilience in the past, and it should be able to overcome the current risks to continue providing reliable income each month. However, a bad recession or more theaters filing Chapter 11 could result in a dividend cut or price decline. It entered 2024 with lots of liquidity and a strong balance sheet, giving it the cash to acquire more experiential real estate. With movie theaters facing disruption from online streaming, EPR plans to acquire more attraction-related properties that consumers can only experience outside the home. That could improve its dividends' long-term durability. Number 3. LTC Properties Incorporated, ticker, LTC. LTC Properties is a healthcare REIT that owns and leases 202 senior housing and skilled nursing facilities in 29 states across the country. Mortgages, mezzanine loans, and triple net leases all contribute to LTC Properties income. The pandemic hit the senior housing sector hard, impacting LTC Properties tenants. Several struggled to pay rent, which led some to file for bankruptcy. However, this REIT used its financial strength to weather the storm and offset some of the lost income with new investments. That's allowed it to maintain its monthly dividend. As the pandemic ends, the market should get better, so LTC Properties rental income should go up in 2024. When recent investments are taken into account, this REIT's high monthly dividend seems like it will last. Number 2. SLGreen Realty Corporation, ticker, SLG. SLGreen Realty is an office REIT and the largest office landlord in New York City. The REIT owns 62 buildings totaling 33.6 million square feet. While the city's office sector has faced some pandemic-related challenges, SLGreen has held up relatively well. That's due in large part to its focus on owning some of the highest quality office properties in the city. That's benefiting this REIT as the city's office market recovers and tenants focus on leasing quality space for their employees. The company exceeded its leasing target in 2023 and expects to sign even more leases in 2024. The demand shows that companies expect to return to their Big Apple offices in the future. SLGreen is not a well-loved stock on Wall Street because of fears that at-home workers will not return to office work. Short interest is also very high. But the price to FFO of 5.67 indicates that much of that fear is already baked into the stock price. The annual FFO of $6.70 provides huge shade over the yearly dividend of $3.73 and yields a whopping 9.83%. At a recent price below $38, it seems to have more upside potential than downside risk. With market conditions on the upswing and new developments paying off, SLGreen should be able to continue expanding its dividend in the future. Number 1. STAG Industrial Incorporated, ticker, STAG. One company that has greatly benefited from the growth of e-commerce is STAG Industrial. This REIT specializes in the operation of industrial and logistics warehouses, with roughly 40% of its portfolio directly servicing the e-commerce industry. Given today's market volatility, share prices are down almost 11% year to date, making it a great time to double down on this dividend-paying growth stock. STAG is one of the largest industrial REITs in the space, with interest or ownership in 517 buildings for a total of 103.4 million square feet of leasable industrial space across 60 metro markets. While e-commerce is the primary industry it serves, it's diversified across 45 different industries within this sector. STAG Industrial owns and operates 563 single-tenant industrial properties across 41 states. Amazon.com Incorporated is STAG Industrial's largest tenant and accounts for about 3% of its total rent. E-commerce isn't slowing down, if anything, it's gaining momentum. The more demand we see for online shopping, fast shipping, and easy returns, the more demand there will be for industrial space. STAG Industrial's third quarter earnings were good and the core FFO of 57 cents beat last year's same quarter results of 53 cents per diluted share. The annual FFO of $2.20 covers the $1.46 dividend and yields 4.59%. In addition, STAG is one of the higher dividend-paying industrial REITs with 10 years of consistent dividend raises. STAG is favorably valued as it relates to its performance. It has clear long-term demand drivers and major opportunities for growth, given its acquisition activity and exposure to the e-commerce market. Which of these monthly paying REITs would you consider adding to your investment portfolio? Let us know in the comments below. Remember to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thank you for watching.